The stock market, it can feel like this huge, complicated universe, right? Well, what if I told you that in just the next few minutes, we're going to give you a clear map to how it all actually works? Let's dive right in.
You know, this is the exact question that just stops people right in their tracks. You open up a trading app and see thousands of companies. It's totally overwhelming. But what if there's a really simple way to make sense of it all?
All right, so here's our game plan. First, we're going to meet the referee who keeps everything fair. Then we'll see how all those companies are organized. After that, we'll talk risk, meet the 4 types of players in the game, and finally, we'll uncover who really calls the shots.
Okay, first things first, the rule maker. Think about it. Any big system, whether it's a sport or a city, needs someone in charge to make sure there's order and fairness. The stock market is no different.
And that regulator has a name, SEBI. That stands for the Securities and Exchange Board of India. Since 1992, they have been the top authority, the ultimate watchdog for the entire Indian stock market.
Honestly, the best way to picture SEBI is as the market's referee. It's their job to blow the whistle, call the fouls, and make sure nobody is cheating. They're there to keep the game fair for everyone, from the smallest investor to the biggest institutions.
So we've got our referee. Now let's look at the teams on the field. With thousands of companies out there, how does SEBI even begin to organize them? Well, it turns out they've broken them down into just 3 main categories.
But before we get to those categories, you need to understand one key idea: market capitalization, or just market cap for short. All it is really is the total value of a company on the stock market. You just multiply the share price by the number of shares out there. It's basically the company's total price tag.
And check this out. This table breaks it down perfectly. SEBI uses market cap to sort every company. Now you can sort them by their total value, and just for reference, 1 crore is 10 million rupees. But the way everyone really does it, the most common way, is by rank. It's super simple. The top 100 biggest companies are large cap. The next 150, from rank 101 to 250, are mid cap. And every other company after that, thousands of them, they're all small cap.
Okay, so we've got our categories, large, mid, and small. But what does that actually mean for you as an investor? Well, it all boils down to one thing, the classic trade-off between risk and reward.
I absolutely love this analogy because it makes things so clear. Think of large cap companies as elephants. They're massive, they move slow and steady, and they're incredibly stable. You're not going to see them sprinting. Small cap companies, they're the complete opposite. They're like racehorses. They can be super fast, super exciting, and they can win you big, but they're also way more unpredictable and a whole lot riskier.
So really, it's about what you're looking for. Large caps are your safest bet, but they grow slowly. Small caps have the highest potential for explosive growth, but they also come with the biggest risk. And what about mid caps? Well, they're that perfect middle ground, a nice balance of moderate risk and moderate growth potential.
All right, we've got the rules, we've mapped the companies, but who's actually out there doing all the buying and selling? It turns out there are really just 4 main types of investors driving the market.
First up, we have retail investors. And hey, this is probably you and me. We're the individuals putting our own savings into the market. We might be the smallest players individually, but together, we're the lifeblood of the system.
Next, you have the HNIs, which stands for high net worth individuals. These are people just like us, but they're investing on a much, much bigger scale. We're talking personal investments of over 1 crore rupees.
Now we get to the big guns. These are the DIIs, or domestic institutional investors. Think of huge Indian organizations like mutual funds or insurance companies. What they do is pool together money from millions of regular people and then invest those massive funds right here in the Indian market.
And finally, we have the other giants on the field, the FIIs, or foreign institutional investors. These are massive institutions from all over the world, maybe a bank in the US or a mutual fund in Japan, and they are pouring billions of dollars of foreign money into the Indian market. So we've got our 4 players, the small retailer, the wealthy HNI, and the 2 giants, the DIIs and FIIs. So the big question is, who actually has the power to move the needle? Who really steers the entire market?
Well, this chart says it all. I mean, just look at those numbers. It's absolutely staggering. The FIIs and DIIs, the institutions, together control 90% of the money flowing through the market. When they make a move, they're moving billions. It creates these massive waves that the rest of us just ride. All of us retail investors combined, we're just 3%. The institutions are the ones running the show.
So what on earth does this mean for a new investor like you? It leads to this incredibly simple but powerful piece of advice. The wind in the market? That's the huge flow of cash from the FIIs and DIIs. So instead of trying to fight that powerful current, the smartest thing you can do is figure out which way the wind is blowing and just walk in that direction.
And here's the best part. You can actually do this. You can track that wind, and it's totally free. Every single evening around 8 p.m., the National Stock Exchange website puts out a report. All you have to do is search for FII DII data, and it'll show you if these big institutions were net buyers or sellers for the day. It's a fantastic clue about which way the market is leaning.
So let's bring this all together. The real takeaway here is about making things simple. As a beginner, you can make a strategic choice to avoid those risky, unpredictable small caps for now, and instead just focus on the top 250 companies, the large and mid caps. Just like that, you've taken a list of over 8,000 companies and cut it down to a manageable 250. It's a total game changer.
So there you have it. We've looked at the landscape and the rules of the road with SEBI. We've seen the different types of vehicles, the large, mid, and small caps, and we've identified the powerful drivers, the FIIs and DIIs. You officially have the map. The only question left is, where do you want to go first?